Today I'm talking about the 3 UK stocks I'm buying right now. I bought these 3 UK stocks this week. I thought it was a good time to add into my UK portfolio. I've not talked about some UK stocks for a little bit just because there's so many bargains on the US stock market at the moment, especially in the US small market cap space. I'm trying to buy a lot of them and I thought this week, you know what, I need to put some funds into my UK stock market portfolio, and these are the 3 UK stocks I bought this week. Now, sorry there was no video yesterday. I basically ended up spending 10 hours making a exclusive video on Patreon, which was how to value growth stocks. So if you are on the Patreon, do go check that video out. It's about 15 minutes long and it goes through quite a few things. If you do want to join the Patreon, there's a link in the description, and on there you can view exclusive content like that video. There's 2 exclusive videos a week, as well as a Discord with 600 members on that are always talking about stocks. I post when I'm buying and selling stocks as well on there, and it's pretty good for £5, and I'm trying not to be biased about it, but for all that stuff that you get in there with the exclusive videos, the Discord on there, buy and sell alerts, is a great community, and for £5, £1 a week nearly, I think it's a pretty good value. If you do want to start investing, there's some links to some brokers in the description, like Free Trade, like Stake. You join through there, you get a free share as well. With the Free Trade one, it's just increased to the minimum stock you can get is £10 to £200, which is pretty good. And on Stake, they're doing a special offer this month that if you join through the Stake link, which is the first link, you also get 2 free shares through the month of August as well. Let's take a look at the 3 UK stocks I'm buying at the moment, which number 1 is Hollywood Bowl. So I have started buying some more shares in Hollywood Bowl. It's a company that I have not bought for about a year. I've not really bought this one since 2020, and I took a massive averaging up this week on Hollywood Bowl. So I'm up on this company. I think I was up something like 60-70%, and I have averaged up quite a big amount on Hollywood Bowl to make it quite a big position. It's still in my portfolio. I will do a portfolio update in a few weeks time because I said I would do them every quarter, and it's kind of getting towards there now, so I will do a bit of a portfolio update sometime soon on the channel. But my Hollywood Bowl position, I averaged up quite a bit on this one, and now Hollywood Bowl is, my portfolio is still S4 Capital, then Boohoo and Greggs and Hollywood Bowl are pretty much tied in 3rd place at the moment. I am kind of feeling that I do really love this company, and I've always said that it could be a number 1 position for me, and I feel like the numbers they're going to put in next year are going to be fantastic, and it has a lot of potential, and Hollywood Bowl could easily for me come ahead of Greggs and even take over Boohoo, so there could be even more averaging up that I do on this company, because I believe the upside with the expansion plans will reflect in the share price because of profit and revenue growth in the next few years, and because of that reason I'm thinking about making it even bigger and averaging up even more. And it's one of those where you've got to kind of not get stuck in your pride of having a stock that's up 40, 50, 60%, and some people I know have it even higher than me, have it even higher returns on this one from last year. But there's a bit of it where you kind of got to not get too carried away with how much you're up, and think about how much potential has this to go up even more in the next 2 to 5 years. And when I look at that, I think about buying more Hollywood Bowl. So if you don't know what Hollywood Bowl is, they have about 70 centres at the moment, and this is what the locations look like. They have a big glowing pink H, and inside here they've got like a bar area, they have an arcade area, and then obviously the bowling area as well. And they make a lot of good revenue from all these different areas that they do have. They're also going into put starters now as well, and expanding into like the mini golf area as well. So this could be a 4th income stream that Hollywood Bowl do have. And the thing with these Hollywood Bowl locations is they're very good at selecting them. They always tie them into areas which you would kind of go out, and then you might go to Hollywood Bowl, you go bowling, you might get a drink at the bar, and then you might go to the arcade after. And then because of the areas that they're in, you might even go to the cinema. There's normally a cinema nearby, and also there's probably a couple of restaurants that you might go to afterwards, like your Nando's or Frankenbenny's, but they seem to be shutting down like crazy at the moment, TGI Fridays. So the locations of this really tie in very well. And as well, what I do like is the amount of diverse income stream that they do have in their centre. So even if you don't go bowling, you might be walking past and you might go, oh, do you want to go in and play a game of pool or go on the arcade machine? So I think because of the diverse revenue they have now, they're not just relying on the bowling. Now, if you do have a look at the stock price, it did have a pretty good run up from 2018, especially going into 2020. I think people are starting to realise how good this company is, and also the plans they have for expanding the centres. But then, unfortunately, obviously, when we get around to January time, the rumours of a big pandemic coming from China started coming out, and yeah, the stock fell off a cliff. Since then, it basically traded quite flat, and then it wasn't until we kind of got the vaccine news that we saw the stock kind of kick on. But even from a stock point of view, it's still, we used to be like a £3 stock, and we're still around £2.30 at the moment. So I think that this company should go higher than that, because it is going to put more revenue and profit in than when it was pre-CV. And for sure, I think this is easily a £3.50 stock right now, and then you consider where it'll be in 2 to 5 years. I can see this eventually going to be a £5 stock in the next 2 to 5 years. Now, the next kind of update, judging on previous years, will be around October time for Hollywood Bowl, and we'll get some really good information on there. But the funny thing about Hollywood Bowl is that this is one of the industries that's been hit the most because of the CV. So far at the moment, basically on all these trading updates, Hollywood Bowl has pretty much only been open like 1 month, which was like around like August time, and that was the only time they were actually allowed to be open in 2020. Nightclubs have pretty much been shut, and they've only been able to open up in like pretty much, was it March time 2021. Very much like leisure centres, like ice skating rinks, bowling alleys. These were really hit hard, and the government pretty much hasn't allowed these to open since the whole CV situation happened. And that's the thing, is like there's not really that much financial numbers that have come out of Hollywood Bowl because they've not been allowed to be open. And basically, when we get a trading update in October, that'll be the first time that we'll have some consecutive months of Hollywood Bowl being open. The only numbers we have got from Hollywood Bowl have been actually really good. So the 1 month they were kind of allowed to be open, which was a full month through October. There was a bit of August, and then I think November we went back into lockdown. But the 1 month they were open in 2020, you can see here there were profitable trading after the first lockdown with solid performance in October. So the 1 month they were allowed to open pretty much in 2020 was fantastic. They went straight to profit, and also revenue growth was pretty strong in October as well. So the thing is, well, what you got to remember with October is that there was, I think, the rule of 6 in at the time. Basically, there was some centres that were basically having gaps between lanes, so that even a lot of the centres weren't fully open. Some of the arcades were closed and everything. So to have profitable trading with a lot of restrictions in place was impressive. So if you put into context now, okay, that was 1 month in October, what happens if we have consecutive months? Lockdowns are easing, you don't have to have the gaps between the lanes. There's a lot of room for even better couple of months as well. And you'll see here the plan for the expansion in the next 2 to 5 years. You'll see they've got 2 new centres here. They've got 3 new Hollywood Bowl in negotiations, and also 8 put starters. So this is a new thing they're expanding on. And also by 2024, they're going to their overall target to double to 14 to 18 new centres by 2024. So that's a massive increase on where they are right now. And that's why I kind of think over the next kind of 2 to 5 years, if they're opening 14 to 18 new centres, what we'll see is the share price go to £5, in my opinion. Also, on the update that we had before going into the CV situation, the company was doing very well. So the 5 first months of the financial year were very strong, with revenue up 12.5% and like-for-like revenue up 9.4%. So this is a company growing at a very healthy double-digit rate, and that's what I like about it. And considering that this company will trade somewhere around like a 19p ratio at the moment, and it's a double-digit growth company, that's a pretty good valuation from my point of view. Now, you see on the past performance, the company has grown revenue very well, and this is what's starting to happen. I think that was what was starting to get reflected in the share price, is the amount of new centres that are opening, and that was reflecting in good revenue growth. And you can see here the amount of profit growth that was starting to happen on the company as well. Financially, the company is very strong. It's got a 31% debt to equity, which is pretty good. If you look at assets to liabilities, the assets to liabilities are pretty good as well. We look at the balance sheet, there's 28 million in debt, and they've also got 37 million in cash. So for me, that's a very strong cash to debt as well, which is good. They did used to pay a little bit of a dividend. The dividend at the moment obviously has been stopped. We'll see if that comes back. I'm not too sure how I feel about a dividend coming back. I don't know if I'd prefer them to focus on expansion, paying a bit of debt down before they do come to a bit of a dividend. But yeah, it used to pay a bit of a dividend yield as well. There used to also be a bit of a special dividend, I believe, so that's why maybe it looks a bit high, like a big jump here, because we're doing so well. So yeah, we'll see what happens with that one, but just thought I'd make you aware they did used to be a bit of a dividend player not so long ago. And just going into the point of view on the ownership of the company, you can see there's been a lot of heavy buying in March time as well. So you can see that I think a few people kind of thought inside the company thought, you know what, it looks like lockdown's going to stop. Our company's very good value. We're going to buy, and yeah, this is a very good sign in the company as well. And also, I want to make a point that Steve Burns is. I'm very happy as him as a CEO as well. I think he's done a very good job expanding the company as well. So number one is Hollywood, and yeah, bought some more in this one. And like I said before, I could probably see me buying a few more shares in this one, because I am liking the company at its current valuations. Number two is Hotel Chocolat, and I've been lazy and writing the ticker symbol on this one again. I think if I was to put Hotel Chocolat, I'd end up covering it with my shoulder, to be fair. But yeah, Hotel Chocolat is number two. I bought some more shares in this company as well. So I'm sure you've probably seen these guys on the high street. They've got quite a few stores around. So I've been buying this company now for probably about 4 months at the moment, just building a nice little position while we're having this little dip here. Same for this company. This company was nearly a £5 company, so it's on about a 23% dip at the moment. I think that when we get some more financial results, I think this could potentially go to a £5 company as well in the next 2 to 5 years. Now, the thing I like about this company is that during the whole lockdown situation, all their stores are being shut. The company actually posted in really good numbers, and I kind of look to this company and think, okay, if it's a company that's expanding very good internationally and online growth, sure, online growth might come down a little bit because the stores are open in the next few months, but the online growth and the international growth is very good. Now, if you add the stores reopening, then this is going to be a company that grows revenue at a really good rate, and it's starting to show that right now. So the big thing about this is that it's basically been a UK company, but now it's expanding online and also in the US and into Japan. And obviously then you think, okay, what happens if it goes past them two countries? Then it's going to be a very good growth story internationally. So just for example here, if we look here, they kind of put financial year 21 revenue of 165 million, and you got to remember there's a lot of stores closed in here, so you add the stores in here as well, it's going to be very impressive. And you look here and it's an increase of 21% compared to financial year 20, and if you look here, an increase of 24% compared to financial year 19, being the last financial year before, can't say that word, impact. So you can see here the numbers are really strong, and like I say, you add in as well a lot of these stores coming back open as well, the high street boom. I think they're going to put some really fantastic numbers in, and like I say, it's not being reflected in the share price at the moment. You can see here, this is the UK database growing 66%, which has also helped to subscriptions. And you can see here in the US, product sales have increased by 62%. And also you can see here in Japan, the joint venture partnership sales grew 277%. So like I say, I'm looking at this company now thinking where it was 2 years ago, and compared to 2 years ago, obviously it has its stores still, but its online growth, its US growth, its Japan growth, over the next kind of 5 years, I can see this coming a very strong international company as well, which is why I'm kind of investing in this company. And like I said, when I go back to where it was, I think in 2019, people were kind of realising that, and it had a very good 2019, but I think it has the potential to go past where it was previously. Now, if you look at the company point of view, you can see here, this is where it was growing profit and revenues steadily before 2019, and then it's going to sharply still increase that profit and revenue as well, which I really like about the company. It's a very strong, previously it's performed very strong, and it'll grow, in my opinion, it'll grow even faster now as well. Financially, you can see assets to liability is lovely. Zero debt on the balance sheet, which is really good. Very, very strong balance sheet. And you can see here, no debt, sitting on 47 million cash, which is pretty good. They did pay a little bit of a dividend. That dividend once again has been stopped. It'd be interesting to see if they do come back to paying a dividend, because obviously they'll probably put a lot of investment in the company at the moment. So yeah, we'll see what happens with that one. Management are very good. If we go on to the ownership of the company, you can see here the CEO and co-founder, both Angus Taylor has a big stake in it, and you can see the other co-founder here, Peter Harris, has a big stake in the company. Between them, they own over half the company as well, which is really good. Founder led, got skin in the game. That's a big thing for me. So it's good to see everything there. So yeah, overall, I think when you look at Hotel Chocolat, I think the financial results they put in the CV situation were amazing. You're adding all the stores opening up, and the international story could carry on growing. I think that's a very good play to have, and I've just been averaging into that one over the last kind of 3 to 4 months. So yeah, been buying up a few shares in Hotel Chocolat. And number 3 is Catebox. So I've only ever bought this company once, and I kind of bought the company and thought, right, I'm going to see if it has a bit of a pullback and then I can build my position. After sitting on this one for a couple of months, it hasn't had much of a pullback, so I'm starting to build my position now. Pretty much flat on it. I'm pretty much flat on this company, so I'm building up my position. So I'm going to try to do this over like the next kind of 6 to 12 months. And I'm building that position into a company called Catebox. So Catebox here, you can see the stock chart. It's had a very good 2020. The final financial results were really good. And once again, you talk about a company that had most of its stores pretty much totally shut down. And a lot of this was online and curbside pickups, and now you're adding the stores reopening. In my opinion, it should be pretty good. It does trade at a little bit of a high premium. There was a one-time charge in there, so it will be a little bit lower when that one-time charge does go out of it. It does pay a little bit of a dividend. It is a 127 million market cap. This is the thing with a lot of these UK stocks. You do have to be careful that they are quite small market caps, meaning they will move around a fair bit, so you just have to be careful. It also does mean as well, a lot of these companies there's not much liquidity there, so you have to be very careful. Like Trading 212 can be a horrible platform to buy these stocks on. Personally, a lot of these companies I buy on DeGiro at the moment, just because it's easy to get the trades in. But I'm just gonna it's probably a point me just saying that. I think I've already covered it a lot of times, but there's always someone in the comments like that says it, and I'm like, I've mentioned it about 100 times, but I'll mention it 101 times, so there we go. Now you might recognise the stores. They do have, very standout stores in this kind of pinky purple. I don't know, is that pink or purple, would you say? I'll go with purple. You might see a lot of these stores. They also have they're starting to open like kiosks as well now, which are becoming quite popular, but they're expanding very quickly. Now, just going on to the financial results, you'll see this is compared to the prior year, and like I said, this is with a lot of their stores shut down for most of the year. You'll see that the revenue growth was 16%, gross profit 23%, pre-tax profit 10%. You'll see the earnings per share here. You can see the one-time charge here, GDPR breach that cost them 500k. Hopefully it looks like they've pretty much sorted all that out, and they'll probably learn from that. Online growth 84%. Now I don't think that will be as strong going forward as what it has done, but it's good to see how much online growth they did have. Now this is the big thing for me, is they've going to expand here, 24 new franchise stores here, and they've got 157 franchise stores as of the 31st of March compared to 133. Now over the next few years, that's probably going to expand to nearly 300, which is why I'm kind of investing into it. They're going to double the amount of stores they do have on here, which is kind of why I'm getting in. Successful ongoing trial of 5 kiosks with a national supermarket chain and 4 new shopping centres kiosks, taking total number of kiosks to 21. So I think this is something else they can expand on. I've seen one of these actually in the Trafford Centre, and it was actually really busy for people queuing up for them, and I think those little kiosks will actually be very good for them, and they can make a lot of money off them. And you can see here, this is the outlook, which they're going to target 18 to 24 new franchise stores openings in financial year 2022. Like I say, I think that they could be targeting massive amounts of stores opening. That's why I think in the next kind of 5 years we could be talking about nearly 300 franchise stores going forward, which will be very good, and that will be shown in the profit and revenue, and I think the share price will move up when they start noticing that. Now you can see here, historically this company's grown profit and revenue at a very good rate, investing very heavily back into the company as well, so the profit could be a little bit higher, but they're choosing to keep expanding it, and it shows on that revenue front, which is really good. If you look at the balance sheet's getting stronger and stronger. We are sitting on 13% debt to equity at the moment, very healthy. Not very worried about that one. You see assets to liabilities outweigh them in the short term and long term. You look at the debt, 1.5 million, sitting on 5.5 million on the balance sheet, which is good. Used to pay a bit of a dividend yield at 2.35%. So this could also pay a bit of a dividend stock as well, which is good. You'll notice that I'm playing a lot of these UK stocks at the moment that offer growth and a dividend. I think that's a lovely combination. And if we look at the company as well, it's a co-founder led company, which obviously I like it as well. And if you look at the insider holding as well, you can see here CEO, co-founder, 31% stake in the company, and you can see here the other co-founder as well owns 10% stake in the company as well, which I like. So yeah, the insiders the CEO co-founder led with owning just over 40% of the company as well, which is a good thing that I like to see. So number 3 was Cake Box, and you can see here that I am, particularly with these 3 companies, I'm looking at companies that have performed very well in the CV situation, and then you're going to have the boom of the opening and people going out again, and their stores as well. Starting to pick up more sales. So yeah, over the long term, 2 to 5 years, I really like these companies, and I think where they're expanding to with the amount of stores are all opening up, or international expansion will be shown in the revenue and profit. And then if the revenue and profit grows on these 5 companies, I think that will be reflected in the share price further down the line. So hope these 3 UK stocks I'm buying right now was a useful video for you guys. If it was useful, hit the like button. If you're new, subscribe, and I'll see you in the next video.